In the autumn of 1929, Yale economist Irving Fisher declared that stocks had reached a permanently high plateau. 9 days later, the market lost everything. In the summer of 2008, Federal Reserve Chairman Ben Bernanke assured Congress that the subprime crisis was contained. 60 days later, Lehman Brothers ceased to exist. Now it is 2026. The Dow has tripled since its pandemic lows. Household wealth has never been higher, at least on paper. Unemployment is manageable. Inflation seems tamed. And once again, the experts are telling you that the system is stable. But beneath the surface, something is breaking. Debt levels that dwarf 1929 and 2008 combined. Asset bubbles inflated beyond anything in recorded history. A monetary experiment with no precedent and no exit strategy. The pattern is always the same. The blindness is always the same. The ending is always the same. What if you're living through the final months before the largest financial collapse in human history, and no one is telling you? Every great collapse announces itself in whispers before it screams. There is a structure to financial disaster, a blueprint that has repeated with haunting precision across 5 centuries of economic history. From the Spanish Empire's serial bankruptcies in the 1500s, to the British pound's humiliation in 1992, from the Soviet Union's economic disintegration to Wall Street's near-death experience in 2008, the architecture is always the same. Debt accumulates, confidence inflates, warning signs are ignored, and then, in a matter of days or weeks, decades of accumulated wealth vanish into nothing. We are taught to believe that modern economies are different, that central banks have learned the lessons of history, that sophisticated financial instruments have eliminated risk, that the sheer size and complexity of global markets makes them more resilient, not more fragile. This is the same lie every generation tells itself before the fall. In 1929, America was the rising power of the world. Its stock market had delivered a decade of extraordinary gains. New technologies, radio, automobiles, electricity were transforming daily life. Credit was abundant. Optimism was universal. The economist Irving Fisher, one of the most respected minds of his era, declared just days before Black Tuesday that the market had achieved permanent prosperity. The crash that followed erased $14 billion in market value in a single day, roughly $200 billion in today's money. But that was only the beginning. Over the next 3 years, the Dow Jones Industrial Average would fall 89% from its peak. Banks failed by the thousands. Unemployment reached 25%. The Great Depression that followed did not merely damage the American economy. It reshaped the political order of the entire world, contributing directly to the rise of fascism in Europe and the outbreak of the deadliest war in human history. 79 years later, the pattern repeated. By 2008, the American financial system had evolved into something unrecognizable from its 1929 predecessor. Global banks held trillions in assets. Derivatives markets had grown to notional values exceeding $600 trillion. Mortgage-backed securities had been sliced, packaged, and sold to investors on every continent. The Federal Reserve commanded tools and resources that its Depression-era counterpart could never have imagined. And yet, when Lehman Brothers filed for bankruptcy on September 15, 2008, the entire system came within hours of total collapse. Credit markets froze. Money market funds, considered as safe as cash, began breaking the buck. The chairman of the Federal Reserve and the Secretary of the Treasury, in private meetings with congressional leaders, warned that without immediate intervention, there might not be an economy left by Monday. The bailouts that followed were unprecedented in scale. The Federal Reserve's balance sheet exploded. Governments worldwide pumped trillions into failing institutions. The system was saved, or so we were told, but here is what they did not tell you. The fundamental imbalances that caused 2008 were never corrected. They were amplified. The debt that nearly destroyed the global economy in 2008 has more than doubled since. The speculative instruments that froze credit markets have grown larger and more complex. The wealth inequality that destabilized societies has accelerated to levels not seen since the Gilded Age. Every crisis in modern history has been solved by creating the conditions for a larger crisis to follow. The savings and loan collapse of the 1980s was resolved by policies that inflated the dot-com bubble. The dot-com crash was cushioned by interest rate cuts that inflated the housing bubble. The housing collapse was addressed by money printing on a scale that has inflated everything: stocks, bonds, real estate, cryptocurrencies, simultaneously. This is the everything bubble, and it is the largest in human history. What happens when it bursts? The answer is not a recession. It is not a market correction. It is not even a repeat of 2008. What is coming is the conclusion of a debt supercycle that began in 1971 when the United States severed the last link between the dollar and gold. Since that moment, the global financial system has operated on pure faith. Faith that governments can print money indefinitely, that debts can grow forever, that tomorrow's growth will always pay for today's success. That faith is breaking. In the sections that follow, we will trace the architecture of collapse that has made this moment inevitable. We will examine the 7 stages that precede every major crash and show how far along this path we have already traveled. We will explore the debt supercycle that has loaded the global economy with obligations it cannot possibly honor. We will document the bubble in everything and the triggers that could cause it to burst. This is not prophecy, this is pattern recognition. The crash of 2026 will not surprise historians who study it decades from now. The evidence was always there. The warnings were always visible. The question is whether you will see it in time. Financial collapses do not arrive without warning. They follow a script. In 1978, economist Hyman Minsky proposed a theory that would be ignored for decades and vindicated in every crisis since. Minsky argued that stability itself breeds instability, that the longer a financial system appears safe, the more risk accumulates beneath the surface. His framework was dismissed by mainstream economists who believed markets were self-correcting. Then came 2008, and suddenly everyone was a Minsky scholar. But Minsky's insight was not new. It was a rediscovery of patterns that careful observers had documented for centuries. The Dutch tulip mania of 1637, the South Sea bubble of 1720, the railroad panics of the 1800s, the Great Depression, the Asian financial crisis, the dot-com collapse. Every one of these disasters followed the same sequence of stages, a progression as predictable as the acts of a tragedy. There are 7 stages to financial collapse, and the terrifying truth about 2026 is that we have already passed through 5 of them. Stage 1, displacement. Every bubble begins with a story. Something new enters the economy, a technology, a market, a monetary policy that creates legitimate excitement and genuine opportunity. This displacement changes how people think about value and possibility. It provides the rational foundation upon which irrational excess will later be built. In the 1920s, the displacement was electrification and mass production. America was being transformed by automobiles, radios, and appliances that promised to change daily life forever. The economic logic was sound. These technologies did create enormous value. The stock market's initial rise was justified. In the early 2000s, the displacement was the internet, a global communication network that would reshape commerce, media, and human connection. Again, the excitement was warranted. The technology was revolutionary. In the 2020s, the displacement is artificial intelligence. For the first time in history, machines can perform cognitive tasks once reserved for humans. The productivity implications are staggering. The investment thesis is compelling. The early money flowing into AI is not irrational. It is responding to a genuine transformation. But here is what history teaches us. The legitimacy of the displacement is precisely what makes the eventual bubble so dangerous. Because the story is partly true, people lose the ability to see when it becomes a fantasy. Stage 2. Credit expansion. Once the narrative takes hold, credit begins to flow. Banks lend more freely. Investors borrow to amplify their returns. Financial innovation creates new instruments that allow capital to move faster and leverage to grow higher. In the 1920s, margin lending transformed the stock market. Ordinary Americans could buy stocks with just 10% down, borrowing the rest from their brokers. This multiplied both gains and losses by a factor of 10. Money that did not exist was chasing assets that could not justify their prices. In the 2000s, credit expansion reached the housing market. Mortgages were offered to borrowers with no income, no job, and no assets. These loans were packaged into securities and sold to investors who never examined what they contained. The total value of mortgage-backed securities grew from 4 trillion in 2000 to over 12 trillion by 2008. Today, global debt has reached 315 trillion, more than 3 times the entire world's annual economic output. Corporate debt in America alone exceeds $13 trillion. Government debt is approaching 36 trillion and growing by $1 trillion every 100 days. The credit expansion of the 2020s dwarfs anything in recorded history. Stage 3. Euphoria. As asset prices rise, a psychological transformation occurs. Early investors see extraordinary gains. Their success attracts new money. The new money pushes prices higher still. A feedback loop takes hold that detaches valuations from any connection to underlying reality. During euphoria, skeptics are ridiculed. Those who warn of danger are dismissed as bitter pessimists who missed the rally. New metrics are invented to justify prices that old metrics cannot explain. In the 1990s, dot-com analysts spoke of eyeballs and mindshare because traditional measures like revenue and profit made their recommendations look absurd. In the 2020s, we have seen euphoria reach levels that would have seemed like parody a generation ago. Meme stocks rise thousands of % based on social media posts. Cryptocurrencies with no utility achieve market capitalizations larger than major banks. A digital image of a cartoon ape sells for more than a house. The euphoria phase is characterized by a phrase that appears in every bubble without exception. This time is different. The 4 most dangerous words in financial history. Stage 4. Critical mass. Euphoria cannot sustain itself without ever increasing leverage. As prices rise beyond the reach of organic buyers, financial engineering steps in to fill the gap. This is the phase where the system becomes genuinely dangerous. In 1929, the volume of margin loans exceeded the total money supply of several major nations. The market was not just overvalued, it was structurally dependent on borrowed money that would evaporate the moment confidence wavered. In 2008, leverage had migrated into shadow instruments that regulators did not understand and could not track. Credit default swaps, essentially insurance policies on debt, had reached a notional value of $62 trillion, more than 4 times American GDP. When Lehman Brothers failed, no one knew who was exposed or by how much. The entire system became a black box of hidden risk. Today, the derivatives market has grown to over $600 trillion in notional value. Exchange-traded funds have created the illusion of liquidity in assets that have none. Pension funds have loaded their portfolios with alternative investments that cannot be sold in a crisis. The leverage in the system is not merely high, it is unknowable. Stage 5. Insider exit. This is the stage that separates the informed from the victims. In every bubble, there comes a moment when those with the best information begin to sell. They do not announce their departure. They do not warn the public. They simply liquidate their positions, quietly and methodically, while continuing to issue optimistic statements for public consumption. In 1929, Joseph Kennedy, father of the future president, famously exited the stock market after a shoeshine boy offered him stock tips. Kennedy understood that when speculation had reached the shoeshine boys, there was no one left to buy. He sold everything and preserved his fortune while millions lost theirs. In 2007, Goldman Sachs began betting against the very mortgage securities it was selling to clients. Internal emails later revealed that executives described their own products as junk and crap, while publicly marketing them as sound investments. When the crash came, Goldman survived with a massive taxpayer bailout, while their clients bore the losses. We are in stage 5 now. Insider selling has reached its highest level in over a decade. Corporate executives across sectors are liquidating shares at a pace not seen since 2021's peak. Warren Buffett, the most successful investor in modern history, has built Berkshire Hathaway as a cash position to record highs, selling major positions in banks and other financial institutions. Buffett does not sell without reason. The smart money is moving to the exits, and they are doing it while telling you everything is fine. Stage 6. Panic. The transition from stage 5 to stage 6 can happen in days or even hours. A single event, a bankruptcy, a policy error, a failed auction, an unexpected data point punctures the narrative of endless growth. Suddenly, the leverage that amplified gains begins to amplify losses. Margin calls cascade. Forced selling accelerates. Assets that seem liquid become impossible to trade. Prices fall not because of rational revaluation, but because everyone is trying to sell and no one is buying. In 1929, the panic phase lasted roughly 2 weeks. Black Thursday, Black Monday, Black Tuesday, each day worse than the last. In 2008, the acute panic lasted approximately 3 weeks, from Lehman's bankruptcy to the passage of emergency legislation. We have not yet reached stage 6, but when we do, the speed and severity will exceed any previous crisis. Modern markets operate at digital velocities. Algorithmic trading systems that accelerate rallies will accelerate crashes. The panic of 2026 will unfold faster than human institutions can respond. Stage 7. Contagion. The final stage is when financial collapse becomes economic collapse. Bank failures lead to credit contractions. Credit contractions lead to business failures. Business failures lead to unemployment. Unemployment leads to defaults on mortgages, auto loans, and credit cards. Each failure feeds the next in a spiral that can take years to exhaust itself. After 1929, it took until 1954 for the Dow Jones to recover its previous peak. An entire generation of investors never regained what they lost. The economic depression that followed reshaped governments, economies, and the very structure of international order. After 2008, central banks intervened with unprecedented force to prevent full contagion. They succeeded in arresting the collapse, but only by creating the conditions for a larger collapse to follow. When stage 6 arrives in 2026, what tools will remain? Interest rates are still historically low. Government debt is already at unsustainable levels. The central bank balance sheets that absorbed 2008's shock have never been normalized. The 7-stage pattern is not a theory. It is a record of what has happened every time humanity has convinced itself that financial gravity has been repealed. 5 stages are complete. 2 remain. On August 15, 1971, Richard Nixon appeared on television and told the American people that he was taking action to protect the dollar. What he did not tell them was that he was ending a monetary system that had governed global finance for nearly 3 decades, and beginning an experiment that would transform the very nature of money. The decision was called temporary. It has lasted 55 years. Before that August evening, every dollar in circulation was backed, at least in theory, by gold held in American vaults. Foreign governments could exchange their dollars for gold at a fixed rate of $35 per ounce. This convertibility imposed discipline on American monetary policy. The government could not print money without limit because eventually someone would demand the gold. By 1971, that discipline had become inconvenient. The cost of the Vietnam War and expanding domestic programs had created persistent deficits. Foreign nations watching America print dollars to cover its obligations began exchanging their paper for metal. French President Charles de Gaulle sent a warship to collect his country's gold. The American stockpile was hemorrhaging. Nixon's solution was elegant in its audacity. Simply end the promise. Declare that dollars were no longer exchangeable for gold. Transform the world as reserve currency, from a claim on something real into pure faith. Faith that the United States government would manage its currency responsibly. It was the financial equivalent of removing the foundation from a building and expecting it to float. What followed was the greatest expansion of debt in human history. In 1971, total global debt, government, corporate, and household combined, stood at approximately $1 trillion. Today, that figure exceeds $3 to $15 trillion. This is not a typo. Debt has grown more than 300 times over in 55 years. while the global economy has grown roughly 20-fold. The gap between what we owe and what we produce has widened into a chasm. To understand what this means, consider the concept of a debt supercycle. Ordinary business cycles last roughly 7 to 10 years. Recessions occur, debts are liquidated, weak businesses fail, and the economy resets for a new period of growth. This is painful but healthy. The equivalent of a forest fire that clears dead wood and allows new growth. A debt supercycle is something different. It spans generations. It occurs when policymakers respond to each recession not by allowing debts to be cleared, but by creating conditions for even more borrowing. Each crisis is solved by lowering interest rates, expanding government deficits, and encouraging more leverage. The immediate pain is avoided, but the underlying imbalances grow larger. The American debt supercycle began in 1971 and has been building ever since. In the 1980s, the savings and loan crisis threatened to collapse the banking system. The government responded with bailouts and deregulation that encouraged larger banks to take larger risks. Total debt continued to grow. In the 1990s, the emerging market crisis and the long-term capital management collapse threatened global contagion. The Federal Reserve cut rates and flooded the system with liquidity. The dot-com bubble inflated. Total debt continued to grow. In the 2000s, the dot-com crash threatened recession. The Federal Reserve cut rates to historic lows and held them there for years. The housing bubble inflated. Total debt continued to grow. In 2008, the housing collapse nearly destroyed the global financial system. Central banks responded with zero interest rates and trillions in money printing. The everything bubble inflated. Total debt continued to grow. Each intervention was larger than the last. Each bubble was bigger than the one before. Each solution created a larger problem for the future. This is not theoretical. This is arithmetic. The United States federal debt now exceeds $36 trillion. This number is so large that it has lost all meaning for most people. So let us make it concrete. At current levels, the federal government pays approximately $1.1 trillion per year in interest on its debt. This is more than the entire defense budget. It is more than Medicare. It is more than every federal program except Social Security. And it is growing every month. Here is the trap. As debt grows, interest payments grow. As interest payments grow, deficits grow. As deficits grow, more debt must be issued. As more debt is issued, interest payments grow further. This is a spiral with no natural exit. The Congressional Budget Office projects that interest payments will exceed $1.7 trillion annually by 2034. But these projections assume stable interest rates and no recession. If rates rise or the economy contracts, the spiral accelerates. Some argue that government debt does not matter because the United States can always print dollars to pay its obligations. This is technically true and catastrophically misleading. Printing money to pay debts is not costless. It is inflation. And inflation is a tax on everyone who holds dollars. History offers no examples of nations that accumulated debt at this pace and escaped without consequences. But it offers many examples of what those consequences look like. Spain was the superpower of the 16th century, its empire spanning 4 continents, its coffers filled with gold from the Americas. Yet Spain defaulted on its sovereign debt 6 times between 1557 and 1647, not because it lacked gold, but because its expenditures perpetually exceeded its revenues. Each default weakened the empire. Each recovery was shorter than the last. By 1700, Spain was a second-rate power, its century of dominance a memory. France was the dominant European power of the 18th century, its military unmatched, its culture the envy of the world. But the cost of wars, including financial support for the American Revolution, created debts that consumed the monarchy. By 1788, interest payments absorbed more than half of government revenue. When Louis XVI attempted to raise taxes to service the debt, revolution followed. Within 5 years, the king was dead and France was engulfed in chaos that would last a generation. Britain emerged from World War II victorious but bankrupt. Its debts exceeded 250% of GDP. Despite its victory, Britain was forced to dismantle its empire, devalue its currency, and accept subordination to American financial power. The transition was managed more gracefully than France's, but the outcome was the same. An empire brought low by obligations it could not honor. The Soviet Union did not collapse because it lost a war. It collapsed because its economic system could no longer sustain its commitments. By the late 1980s, the gap between what the Soviet state had promised its people and what it could deliver had become unbridgeable. When confidence broke, the entire system disintegrated within months. In each case, the pattern is identical. Debts accumulate, interest payments rise, obligations expand faster than the ability to meet them. A breaking point arrives, and then, with shocking speed, centuries of accumulated power vanish. The United States in 2026 is not immune to this pattern. It is a textbook example of it. Consider the trajectory. Federal debt was 5.7 trillion in 2000. It reached 10 trillion by 2008. It exceeded 23 trillion by 2020. It now approaches 36 trillion and is growing by $1 trillion every 100 days. But federal debt is only part of the picture. Corporate debt has reached $13.7 trillion, nearly triple its 2008 level. Much of this debt was incurred not to invest in productive capacity, but to fund stock buybacks that enriched executives while loading balance sheets with obligations. When recession comes and revenues fall, these debts will become anchors. Household debt has exceeded $17 trillion. Credit card balances have reached all-time highs. Auto loan delinquencies are rising. The American consumer, the engine of global growth, is tapped out. State and local governments carry another $3 trillion in debt, plus unfunded pension obligations estimated between $4 trillion and $8 trillion depending on assumptions. Many of these pensions have promised benefits that the underlying assets cannot possibly support. Added all together, and total American debt, public and private, exceeds $100 trillion, against a GDP of roughly $28 trillion. This is not a problem that can be solved by growth. Growth is measured in percentages. This debt is measured in multiples, and America is not even the worst case. Japan's government debt exceeds 260% of GDP, the highest of any developed nation. Japan has survived this burden only because its central bank purchases most new government bonds with printed money, and its population holds most of the rest. But Japan has also experienced 3 decades of stagnation, deflation, and demographic decline. Its example is not a model for sustainability, but a preview of managed decay. China's debt has exploded from roughly 150% of GDP in 2008 to over 300% today. Much of this debt-funded construction that now sits empty. Ghost cities, vacant malls, abandoned developments. The Chinese financial system is opaque, but the mathematics of its debt suggest a reckoning that could shake global markets. The European Union staggers under sovereign debt burdens that nearly destroyed it in 2012 and have only grown since. Italy, Greece, France, each carries obligations that would be unserviceable without European Central Bank intervention. That intervention cannot continue forever. The debt supercycle that began in 1971 is approaching its terminal phase. The machinery of endless borrowing is breaking down. Interest payments are consuming budgets. Demographic decline is shrinking the tax base. Productivity growth has stalled. For 55 years, the world has lived on borrowed time. Quite literally. Every year, we have consumed more than we produced and papered over the difference with debt. We told ourselves this could continue forever. It cannot. It will not. The only question is when the reckoning arrives. The evidence suggests we will not wait long. There is a photograph from 1720 that historians return to when they want to understand financial madness. It depicts Exchange Alley in London, a narrow lane choked with merchants, aristocrats, servants, and speculators, all of them desperate to buy shares in the South Sea Company. The company had promised to convert government debt into equity and generate profits from trade with South America. In reality, it had almost no actual business. Its ships rarely sailed. Its trade routes existed mostly on paper. None of that mattered. What mattered was that the shares kept rising. From January to August 1720, South Sea stock increased nearly tenfold. Fortunes were made in weeks. A new class of suddenly wealthy speculators emerged, flaunting carriages and estates purchased with paper gains. Isaac Newton, the greatest scientific mind of his age, invested heavily, lost a fortune, reinvested, and lost even more. "I can calculate the movement of stars," he reportedly said, "but not the madness of men." The madness ended in September. By December, the shares had lost 80% of their peak value. Thousands were ruined. The economy collapsed into depression. Parliament launched investigations. Directors of the company were arrested, their estates confiscated. 3 centuries later, we have learned nothing. The bubble that has inflated since 2009 is not merely larger than the South Sea Company's fever dream. It encompasses everything: stocks, bonds, real estate, private equity, venture capital, cryptocurrencies, collectibles, art. Every asset class on Earth has been inflated simultaneously to levels that would have seemed hallucinatory a generation ago. This is unprecedented. In previous bubbles, speculation concentrated in a single sector. The 1920s bubble was stocks. The 2000s bubble was housing. When these bubbles burst, capital could flee to other assets. Bonds provided safety when stocks collapsed. Real estate held value when dot-coms evaporated. Today there is nowhere to hide. Every traditional safe haven has been inflated alongside the speculative assets. When this bubble bursts, there will be no rotation, no flight to safety, only varying degrees of loss. How did we get here? The answer begins with a single institution, the Federal Reserve. In September 2008, as Lehman Brothers collapsed and credit markets froze, the Federal Reserve held approximately $900 billion in assets on its balance sheet. This was roughly the same level it had maintained for decades, growing slowly alongside the economy. Over the next 6 years, that balance sheet expanded to $4.5 trillion. The mechanism was simple in concept. The Federal Reserve created new money electronically and used it to purchase bonds from banks and financial institutions. This quantitative easing was supposed to be temporary, an emergency measure to prevent depression. Instead, it became permanent policy. When markets trembled in 2018 as the Fed attempted to shrink its balance sheet, the central bank reversed course. When the pandemic struck in 2020, it accelerated money creation to levels that dwarfed even the 2008 response. By 2022, the Federal Reserve's balance sheet had reached $9 trillion, 10 times its pre-crisis level. $9 trillion created from nothing and injected into financial markets. Where do you suppose that money went? It went into asset prices. It could go nowhere else. When the Federal Reserve purchases bonds, it does not create goods or services or productive capacity. It creates purchasing power and hands it to financial institutions. Those institutions must deploy the capital somewhere. They deployed it into everything. Consider the stock market. The S&P 500 bottomed at 666 in March 2009. By late 2025, it had exceeded 6,000, a 9-fold increase. Did the American economy grow 9-fold in 16 years? Did corporate profits increase by 800%? Did productivity surge? No, the economy grew by perhaps 80% in real terms. Corporate profits roughly doubled. The rest was multiple expansion. Investors paying more and more for each dollar of earnings. At the market's peak, the cyclically adjusted price-to-earnings ratio, a measure that smooths earnings over 10 years to filter out temporary fluctuations, exceeded 38. This ratio has only been higher twice in American history, in 1929 and in 2000. Both instances preceded catastrophic crashes, but stocks are only part of the story. The bond market has experienced a bubble of equal magnitude, though it is less visible to ordinary observers. For 40 years, bond yields fell almost continuously. Falling yields mean rising prices. A bond purchased at higher yields becomes more valuable as rates decline. Trillions of dollars in paper wealth were created as this trend extended across decades. By 2020, the absurdity had reached its logical conclusion: negative interest rates. Investors were paying governments for the privilege of lending them money. At the peak, more than $18 trillion in bonds worldwide traded at negative yields. This had never happened before in 5,000 years of financial history. Real estate followed the same trajectory. American home prices, as measured by the Case-Shiller Index, have more than tripled since the post-2008 bottom. In many cities, they have increased fivefold or more. A modest home in San Francisco or New York or Boston now costs more than a mansion did 20 years ago. Not because the homes are better, but because the money used to purchase them has been debased. Commercial real estate inflated alongside residential. Office buildings, shopping centers, warehouses, all were bid up by investors chasing yield in a zero-rate world. Private equity funds accumulated massive portfolios of properties purchased with borrowed money at compressed cap rates. This will matter later. Then there are the assets that should not exist at all. Cryptocurrencies emerged from the 2008 crisis as a response to monetary debasement. Bitcoin's anonymous creator explicitly referenced bank bailouts in the currency's founding code. The original vision was sound money beyond government control. What emerged was something different. A speculative mania that makes the South Sea bubble look restrained. At its peak in 2021, the total market capitalization of cryptocurrencies exceeded $3 trillion. Coins with no utility, created as jokes, achieved valuations in the tens of billions. NFTs, digital certificates of authenticity for images anyone could copy, sold for millions. A 12-year-old could create a new token in an afternoon and watch it appreciate 10,000% by evening. The crypto crash of 2022 wiped out 2/3 of this value. The faithful called it a buying opportunity. By 2024, speculation had returned with full force. The lesson of every bubble is that the survivors of the first wave become the true believers of the second. And the second wave is always larger. Private markets have inflated alongside public ones, but with even less scrutiny. Venture capital funds have poured hundreds of billions into startups valued at fantasy multiples of their revenues. Private equity has loaded companies with debt to fund dividends to their investors, leaving the businesses fragile and their workers exposed. The valuations of private companies are not marked to market. They are marked to imagination. The total value of this bubble defies comprehension. American household wealth has reached $160 trillion, a figure that exceeds total American wealth in 2009 by more than $100 trillion. That is, $100 trillion in paper gains are accumulated in 16 years. Not from wages, not from savings, not from building businesses or creating products, from asset price inflation, pure and simple. This wealth is not real. It is a claim on future goods and services that may never be honored. It exists only so long as confidence persists and markets remain liquid. The moment a meaningful fraction of holders attempt to convert their paper wealth into actual purchasing power, the illusion will collapse. The everything bubble has created a doom loop that its architects do not acknowledge. Asset prices have become essential to economic stability. Consumer spending depends on the wealth effect. People spend more when their portfolios and home values are rising. Pension funds depend on high returns to meet their obligations. Government tax revenues depend on capital gains. Corporate balance sheets depend on elevated stock prices to support their debt ratings. If asset prices fall significantly, all of these pillars crack simultaneously. Consumer spending contracts. Pension funds become insolvent. Tax revenues plummet, exploding deficits. Corporate downgrades cascade, triggering covenant violations and defaults. The Federal Reserve understands this. It is why every attempt to normalize policy has been abandoned at the first sign of market distress. The so-called Fed put. The implicit guarantee that the central bank will rescue markets from any serious decline has become the foundation of all financial calculations. But there is a problem. The same policies that inflate asset prices also debase the currency. Inflation returned in 2021 and 2022 with a vengeance that startled policymakers who had declared it extinct. The Fed was forced to raise rates, not because it wanted to, but because the alternative was social unrest as living costs outpaced wages. Higher rates are poison to the everything bubble. They raise the cost of leverage that supports inflated prices. They provide alternatives to speculative assets. They reprice future cash flows downward. The central bank is trapped. Inflate and destroy the currency. Deflate and destroy the markets. There is no path that avoids catastrophe. There is only the choice of which catastrophe to accept. For 16 years, they have chosen to delay the reckoning. Each delay has made the eventual reckoning larger. Time is running out. In the 3rd century, a Roman soldier's salary could buy his family a comfortable life. By the end of that century, the same salary would not cover a week's food. The currency had not changed its name. The coin still bore the emperor's face. But what had once been silver was now bronze with a thin silver wash, a fraud so obvious that merchants refused to accept it at face value. The Roman denarius had been debased to worthlessness over the span of a single lifetime. And with it, something far more valuable was destroyed, the trust that held an empire together. This is the pattern that echoes across millennia. Monetary collapse is never merely economic. It is the visible manifestation of a deeper disintegration, the breaking of the social contract between rulers and ruled, between institutions and citizens, between the present and the future. Rome did not fall because barbarians breached its walls. By the time the Visigoths sacked the city in 410 AD, the empire had already hollowed itself from within. Debased currency had made long-term planning impossible. Tax revenues collapsed as citizens refused to accept worthless money. Trade networks that had connected 3 continents fragmented into local barter economies. The professional army that had conquered the known world could no longer be paid. Soldiers became bandits. Citizens became serfs. The fall of Rome took 3 centuries. Modern collapses move faster. In January 1921, 1 German mark was worth approximately $1 American. By November 1923, it took 4.2 trillion marks to equal that same dollar. A currency that had financed the world's most advanced industrial economy had become cheaper than the paper it was printed on. Workers collected wages in wheelbarrows and ran to spend them before lunch, because by evening the money would have lost half its value. The Weimar hyperinflation was not an accident. It was a policy choice. Germany had financed the First World War with debt, expecting victory to provide the spoils to repay it. Defeat brought instead reparations. Obligations denominated in gold that Germany could not possibly meet through normal taxation. The government's solution was to print marks and purchase foreign currency to make the payments. Each round of printing reduced the mark's value, requiring more printing to achieve the same result. The mathematics were inexorable, but mathematics does not capture the human devastation. A generation of Germans watched their savings evaporate. Middle-class families who had worked for decades, who had set aside money for retirement, for their children's education, for emergencies, these people discovered that their thrift had been punished. The prudent were destroyed, while speculators who borrowed heavily were rewarded with the evaporation of their debts. The psychological impact cannot be overstated. Trust in currency is ultimately trust in civilization itself. When that trust breaks, everything built upon it becomes questionable. Why follow rules written by institutions that robbed you? Why believe promises from leaders who debased your life savings? Why plan for a future that can be stolen overnight? The Weimar Republic never recovered its legitimacy. Within a decade, it was gone, swept away by a political movement that promised to restore German greatness and punish those responsible for the nation's humiliation. The Holocaust, the Second World War, the 50 million dead. The chain of causation runs directly through the monetary collapse of 1923. This is what is at stake when trust breaks. The United States dollar has been the world's reserve currency since 1944, when representatives of 44 nations gathered at Bretton Woods, New Hampshire, to design the post-war monetary order. The system they created was elegant. The dollar would be fixed to gold at 35 per ounce, and other currencies would be fixed to the dollar. America's promise to exchange gold for dollars on demand would anchor the entire global economy. That promise lasted 27 years. Nixon's 1971 decision to end gold convertibility did not destroy the dollar's reserve status, but it transformed its foundation. The dollar was no longer backed by metal, it was backed by faith. Faith in American economic management, faith in American military power, faith in American institutions. For 50 years, that faith held. The dollar remained dominant despite Vietnam, despite Watergate, despite the savings and loan crisis, despite the dot-com crash, despite 2008. Foreign nations accumulated dollars in their reserves because there was no alternative. Oil was priced in dollars. Commodities traded in dollars. International debts were denominated in dollars. The global financial system was built on American currency. But faith, once shaken, is difficult to restore. The events of the 2020s have shaken it. The Federal Reserve's money printing, $5 trillion created in 2 years, demonstrated that the dollar's supply was limited only by political will. The inflation that followed proved that this expansion had consequences. The freezing of Russian foreign exchange reserves after the 2022 invasion of Ukraine demonstrated that dollar holdings could be confiscated by political decision. For nations outside America's alliance structure, this was a clarifying moment. If dollars could be frozen, they were not truly owned. They were held at America's pleasure. The response has been slow but unmistakable. Central banks have increased gold purchases to levels not seen in decades. China has reduced its treasury holdings by hundreds of billions. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding membership have accelerated discussions of alternative payment systems and reserve assets. Saudi Arabia, the linchpin of the petrodollar system, has signaled openness to pricing oil in other currencies. None of this means the dollar will lose reserve status tomorrow. The infrastructure of global finance cannot be rebuilt overnight, but the direction of travel is clear. The unipolar monetary order that has prevailed since 1991 is fragmenting into competing blocks, each seeking to reduce its dependence on American currency. The implications for American power are profound. Reserve currency status allows the United States to borrow at rates no other nation could sustain. It allows America to run trade deficits that would bankrupt any other country. It allows the projection of power through financial sanctions that can cripple adversaries without firing a shot. As that status erodes, so does the foundation of American hegemony. But the collapse of trust extends far beyond currency. It has infected the institutions that once commanded automatic respect. Consider the Federal Reserve. For decades, central bank independence was a sacred principle. The belief that monetary policy should be insulated from political pressure was shared across the ideological spectrum. Alan Greenspan was treated as an oracle. His pronouncements moved markets. His judgment was not questioned. Today, the Federal Reserve is openly attacked by politicians of both parties. Its credibility has been damaged by forecasts that prove spectacularly wrong. The transitory inflation narrative of 2021, the assurances that the banking system was sound months before Silicon Valley Bank's collapse. The mystique of central banking has evaporated. What remains is an institution visibly struggling to manage forces beyond its control. The same erosion has occurred across the institutional landscape. Media organizations that once served as trusted arbiters of fact have fragmented into partisan camps. The same event is reported in incompatible ways depending on the source. Citizens increasingly consume only information that confirms their existing beliefs. Shared reality, the common foundation necessary for democratic deliberation, has cracked. Government institutions face legitimacy deficits not seen in living memory. Congressional approval ratings have languished in the teens for over a decade. Trust in the presidency fluctuates wildly depending on partisan affiliation. The Supreme Court, once insulated from political perception, is now viewed through the same tribal lens as elected branches. Even scientific institutions, the CDC, the FDA, public health authorities, emerged from the pandemic with diminished credibility. Whatever one's view of the specific policies, the result is undeniable. A significant portion of the population no longer trusts official guidance on matters of health and safety. This matters for financial stability more than most analysts acknowledge. Financial systems do not operate on mathematics alone. They operate on trust. The equations work only because participants believe they will work, because counterparties trust that contracts will be honored, that currencies will hold value, that institutions will enforce rules fairly. When trust erodes, behavior changes. Capital seeks safety in hard assets. Time horizons shorten. Cooperation gives way to zero-sum competition. The social fabric that enables complex economic coordination begins to fray. We have seen this before. In the late Soviet period, citizens lost faith in official institutions while maintaining the outward forms of compliance. They showed up to jobs where nothing was produced. They repeated slogans they did not believe. They participated in elections whose outcomes were predetermined. The system looked stable on the surface while hollowing out from within. When the moment of crisis arrived in 1989, the collapse was shockingly swift. Structures that had seemed permanent dissolved in weeks. The internal rot had progressed far beyond what external observers recognized. The United States in 2026 is not the Soviet Union. The comparison is imperfect. But the dynamic of institutional decay, proceeding invisibly until a crisis reveals its extent, the dynamic is universal. The trust that sustains currency, that legitimizes institutions, that enables millions of strangers to cooperate in complex economies. That trust is not infinite. It is not automatic. It must be earned and maintained. For decades, it has been squandered. When the next crisis arrives, the institutions that should respond will find their authority questioned. The currency that should provide refuge will be suspect. The social cohesion that should enable collective action will be absent. The collapse of trust will transform an economic crisis into something far more dangerous. On May 11th, 1931, a bank most Americans had never heard of closed its doors in Vienna. Creditanstalt was Austria's largest financial institution, the product of the mighty Rothschild banking dynasty, the cornerstone of Central European finance. Its failure should have been a regional problem, contained, manageable, forgotten within months. Instead, it destroyed the world. The collapse of Creditanstalt triggered a chain reaction that spread across Europe within weeks. German banks, exposed through intertwined loans and investments, began to fail. The Reichsbank hemorrhaged gold reserves as depositors fled. Britain, financially linked to Germany, faced its own crisis. By September, the pound sterling, the world's reserve currency for over a century, was forced off the gold standard. The global financial system that had slowly recovered from 1929's stock market crash suffered a mortal blow. The Great Depression's worst years followed not from Black Tuesday, but from Creditanstalt. A single bank in a small country set off the cascade that would ultimately lead to fascism, world war, and 50 million dead. This is how financial collapses actually work. They do not announce themselves with obvious causes. They emerge from obscure corners of the system, from risks that experts dismissed, from connections that regulators missed, from weaknesses that everyone assumes someone else was monitoring. The crash of 2026 will follow this pattern. The trigger will not be what the headlines predict. It will come from a direction that seems manageable until suddenly it is not. But while the specific catalyst cannot be predicted with certainty, the candidates can be identified. There are 5 triggers capable of igniting the collapse. Any one of them could be sufficient, and in a system this fragile, any one of them will likely activate the others. Trigger 1: sovereign debt crisis. The mathematics of government debt in major economies have passed the point of sustainability. This is not opinion, it is arithmetic. The United States federal government currently spends approximately $2 trillion more per year than it collects in revenue. This deficit must be financed by issuing new treasury bonds, but the buyers who traditionally absorb this issuance are retreating. Foreign central banks, once the largest purchasers of American debt, have become net sellers. China's treasury holdings have declined by over $500 billion from their peak. Japan, facing its own fiscal pressures, has reduced its purchases. The petrodollar recycling that once guaranteed Gulf state demand has weakened as oil revenues have become less predictable. Domestic buyers have partially filled the gap, but at a cost. When banks and pension funds buy government bonds, they are not buying corporate debt or mortgages or other assets that finance economic activity. The government is crowding out private investment, absorbing capital that would otherwise fund growth. The Federal Reserve itself became the buyer of last resort during the pandemic, purchasing trillions in treasuries with newly created money. But this monetization of debt is precisely what caused the inflation that forced the Fed to reverse course. The central bank cannot simultaneously fight inflation and finance the deficit. Something must give. The most likely breaking point is a failed treasury auction, an event where the government attempts to sell bonds and finds insufficient buyers at acceptable interest rates. This has never happened in modern American history. The assumption that it cannot happen is precisely what makes it dangerous. A failed auction would force immediate choices. The Federal Reserve must resume purchases, accepting the inflationary consequences, or interest rates must spike to attract buyers, crushing the economy under the weight of debt service costs. Either path leads to crisis. The first path destroys the currency. The second destroys the budget. Japan faces an even more precarious situation. Its debt exceeds 260% of GDP, the highest ratio of any developed nation. The Bank of Japan has purchased so many government bonds that it now holds nearly half of all outstanding issuance. This monetization has suppressed interest rates for decades, but it has also created a trap. If Japanese rates rise even modestly, say to 2%, interest payments would consume virtually all government tax revenue. The Bank of Japan would be forced to print even more money to cover the shortfall, further weakening the yen. The currency has already lost over 50% of its value against the dollar since 2012. At some point, decline becomes rout. A Japanese fiscal crisis would not stay contained. Japanese institutions are the largest foreign holders of American bonds. A forced liquidation to meet domestic obligations would flood markets with treasuries at the worst possible moment. The Contagion channel from Tokyo to New York is direct and massive. Trigger 2. Commercial real estate implosion. The office buildings that define American city skylines are becoming tombs. The pandemic accelerated a shift to remote work that has permanently altered space requirements. Office vacancy rates in major cities have reached levels not seen since the savings and loan crisis. In San Francisco, over 30% of office space sits empty. In Chicago, in Los Angeles, in Houston, the pattern repeats. Sublease space, companies trying to offload leases they no longer need, has flooded the market. This is not a temporary adjustment. It is a structural transformation. The commercial real estate industry financed its expansion with approximately $6 trillion in debt. Much of this debt was issued when property values were at their peak and interest rates were near zero. The loans are now coming due. Between 2024 and 2026, over $1.5 trillion in commercial real estate debt must be refinanced. The numbers do not work. Properties worth $100 million in 2021 are now worth $60 million or less. Loans written at 65% loan-to-value ratios are now underwater. Borrowers must either inject massive new equity to refinance, accept crushing interest rates on reduced loan amounts, or default. Many will default. The banks holding these loans are not the too-big-to-fail institutions that dominate headlines. They are regional and community banks, the same banks that provide credit to small businesses, that fund local development, that serve communities ignored by Wall Street giants. Regional banks hold approximately 70% of all commercial real estate loans. We have already seen what happens when regional banks face concentrated losses. In March 2023, Silicon Valley Bank collapsed in 48 hours, the fastest bank failure in American history. Signature Bank followed within days. First Republic fell weeks later. These failures resulted from interest rate risk, not credit losses. The commercial real estate wave will bring both. The Federal Deposit Insurance Corporation has approximately $120 billion in its insurance fund. Total deposits at regional banks exceed $7 trillion. If confidence breaks, the math is impossible. Trigger 3. Derivatives. Market seizure. There is a shadow financial system that dwarfs the visible one. The notional value of outstanding derivatives contracts exceeds $600 trillion. This number is so large that it loses all meaning without context. Global GDP is approximately $100 trillion. total global wealth is approximately $450 trillion. The derivatives market is larger than everything. A phantom economy of bets layered upon bets. Defenders of this system argue that notional values overstate actual risk. The positions offset each other, they claim. The net exposure is manageable. This was exactly the argument made about credit default swaps before 2008. Derivatives function as insurance. Banks use them to hedge interest rate risk. Corporations use them to manage currency exposure. Investors use them to protect against price movements. In normal times, these instruments reduce risk and improve market efficiency. But derivatives also create hidden interconnections. When Lehman Brothers failed, no one knew which institutions had written insurance on its debt or how large the exposures were. The credit default swap market had grown so complex that regulators could not map its topology. The fear of unknown counterparty risk froze credit markets more thoroughly than the actual losses justified. The derivatives market has grown larger and more complex since 2008. Interest rate swaps alone exceed $400 trillion in notional value. A significant move in rates, whether up or down, would trigger margin calls across the system. Institutions that appeared well hedged would discover that their counterparties could not pay. The daisy chain of obligations would break at its weakest link, and no one knows where that link is. In March 2023, the collapse of Silicon Valley Bank briefly threatened this system. The Fed intervened within hours to prevent contagion, but each intervention depletes ammunition and sets precedents for larger interventions to come. At some point, a crisis will move faster than the response. Trigger 4. Geopolitical shock. The global order that has prevailed since 1991 is fracturing. The war in Ukraine has already demonstrated how quickly geopolitical conflict translates into economic disruption. Energy prices spiked, food supplies were threatened, supply chains that had seemed permanent were revealed as fragile. Europe was forced to restructure its entire energy infrastructure in months. This was a regional conflict in a country that, while significant, is not central to global commerce. The next shock may not be so limited. Taiwan produces over 90% of the world's most advanced semiconductors. These chips power everything from smartphones to automobiles to weapon systems to artificial intelligence. A conflict that disrupted Taiwanese production, whether through invasion, blockade, or even credible threat, would paralyze the global economy in ways that make the pandemic supply chain disruptions seem trivial. The Middle East, despite decades of predictions about diminishing importance, remains the linchpin of global energy. The Strait of Hormuz carries 20% of the world's oil supply. The Red Sea route, already disrupted by Houthi attacks, carries 15% of global trade. Regional escalation could close these arteries overnight. Beyond specific flashpoints, the broader pattern is clear. The cooperative international order that enabled globalization is giving way to bloc competition. Supply chains optimized for efficiency must be rebuilt for resilience. This transition will be inflationary, disruptive, and punctuated by crises. Trigger 5. Central bank policy error. The institution tasked with preventing financial collapse may cause it. Central banks face an impossible trilemma. They must simultaneously maintain price stability, ensure financial stability, and support government financing needs. In normal times, these goals align. In the current environment, they conflict. Fighting inflation requires higher interest rates. Higher rates threaten financial stability by straining leveraged institutions and deflating asset prices. But supporting financial stability through lower rates or quantitative easing risks reigniting inflation. And both paths affect the government's ability to finance its deficit. The Federal Reserve's recent history is a case study in policy error. It held rates too low for too long after 2008, inflating asset bubbles. It dismissed inflation as transitory in 2021, falling behind the curve. It raised rates aggressively in 2022 and 2023, triggering bank failures. Each correction creates new imbalances, requiring future correction. The next era could be fatal. Raise rates too far, and the commercial real estate wave becomes a tsunami. Cut rates too soon, and inflation expectations become unanchored. Move too slowly and a crisis outruns the response. Move too quickly and confidence collapses in the institution itself. Central bankers are not omniscient. They operate with incomplete information, political pressures, and models that failed to predict the last 3 crises. The faith that they will navigate the current situation flawlessly is not supported by their track record. The domino theory. The most dangerous feature of the current environment is not any single trigger. It is the interconnection between them. A sovereign debt crisis would crush bank balance sheets, accelerating commercial real estate losses. Commercial real estate defaults would trigger derivatives exposure across counterparties. Geopolitical shocks would accelerate de-dollarization and complicate central bank response. Central bank errors would exacerbate whichever crisis emerged first. In 1931, Creditanstalt failure activated every weakness in the system simultaneously. The dominoes fell not in sequence but in parallel, each failure accelerating the others. The system in 2026 is more leveraged than 1931, more interconnected than 1931, more dependent on sustained confidence than 1931. When the first domino falls, the rest will follow. On the morning of October 30th, 1929, the front page of the New York Times carried a headline that would become a monument to human self-deception. Worst stock crash stemmed by banks. The story described how leading financiers had pooled resources to stabilize the market. The panic was over, and confidence had been restored. The system had held. The Dow Jones Industrial Average would fall another 85% over the next 3 years. This is how collapses unfold. Not in a single dramatic moment, but in phases, each phase bringing its own false hopes, its own interventions, its own assurances that the worst has passed. Understanding these phases is essential for understanding what comes after 2026. Phase 1. Denial and emergency intervention. The first phase lasts weeks to months. It is characterized by official denial, emergency action, and temporary stabilization. When the trigger event occurs, whatever it may be, the immediate response will follow a familiar script. Officials will appear before cameras to assure the public that the situation is contained. The Federal Reserve will announce emergency lending facilities. The Treasury will coordinate with international counterparts. Markets will be closed if necessary to prevent panic selling. These measures will appear to work. They always do, at first. In September 2008, the Troubled Asset Relief Program and Federal Reserve interventions halted the immediate panic within weeks. Markets stabilized. Credit began to flow again. By early 2009, officials were declaring victory. Treasury Secretary Timothy Geithner pronounced the financial system repaired. But the underlying damage had not been addressed. It had been papered over. The debts remained. The imbalances persisted. The crisis had been converted from acute to chronic, a transformation that felt like salvation but was merely postponement. The interventions of 2026 will be larger in scale than anything previously attempted. They will have to be. The debts are larger. The leverage is higher. The interconnections are denser. Trillions will be committed in days. Central bank balance sheets will expand by magnitudes. Governments will guarantee obligations they cannot possibly honor. And for a moment, perhaps weeks, perhaps months, it will seem to work. Phase 2. Systemic breakdown and wealth destruction. The second phase is when the true scope of the damage becomes undeniable. It typically spans 12 to 18 months after the initial crisis. During this phase, the interventions that seem successful begin to fail. The institutions that were saved reveal deeper problems. The assets that were guaranteed prove worthless. The confidence that was restored evaporates as reality overwhelms narrative. After 1929, this phase saw the cascade of bank failures that destroyed the savings of millions. Over 9,000 banks collapsed between 1930 and 1933. Each failure wiped out depositors, contracted credit, and weakened surviving institutions. The monetary system itself began to disintegrate as regions lost access to functioning banks. After 2008, this phase was shorter and less severe because central banks intervened with unprecedented force. But the wealth destruction was still immense. American households lost approximately $13 trillion in net worth. Unemployment reached 10%. Home foreclosures displaced millions. The recovery that followed was the slowest since the Depression. The second phase of the 2026 collapse will be worse than both predecessors. The reason is simple. The tools used to arrest previous crises have been exhausted. Interest rates cannot be cut from zero. They are barely above it. Quantitative easing has already been deployed at scales that triggered inflation. Government balance sheets are already stretched to historical extremes. When the interventions fail to hold, the wealth destruction will be staggering. The $160 trillion in American household wealth is largely fictional, paper gains that exist only so long as markets remain liquid and confidence persists. A 50% decline in asset values, well within historical precedent for severe crises, would erase $80 trillion. This is not money that would move somewhere else. It would simply cease to exist. Entries on balance sheets marked to zero. The social consequences will be severe. Retirement accounts that millions depend upon will be devastated. Pension funds already struggling with unrealistic return assumptions will face insolvency. The wealth gap that has destabilized politics will collapse, not by lifting the bottom, but by destroying the middle. Unemployment will surge as credit contracts and demand collapses. Unlike the pandemic recession, there will be no quick snapback. The debt overhang will suppress investment for years. Companies will fail, not because their business models are flawed, but because the financing that sustained them has vanished. Phase 3, restructuring and transformation. The third phase begins when the destruction is largely complete and reconstruction can begin. It spans years to decades. This is the phase where the true consequences of the crisis manifest, not just economically, but politically, socially, and geopolitically. And the world that emerges from a major financial collapse is never the same as the world that entered it. After 1929, Phase 3 brought the New Deal in America, fascism in Europe, and ultimately World War. The economic catastrophe delegitimized existing political orders and created openings for radical alternatives. The international system that had governed since the Congress of Vienna collapsed. Empires that had endured for centuries disintegrated. New powers rose, old powers fell. After 2008, Phase 3 was truncated by intervention, but the political consequences still manifested. The Tea Party, Occupy Wall Street, Brexit, Trump, Sanders. These movements, whatever their ideological differences, shared a common origin in the financial crisis and the perceived unfairness of its resolution. The bailouts that saved the system also delegitimized it. The third phase after 2026 will force a fundamental restructuring of the global monetary order. The debt-based growth model that has prevailed since 1971 will end, not by choice, but by exhaustion. Debts that cannot be paid will not be paid. The question is only how the losses are distributed, through default, through inflation, or through some combination that assigns pain across creditors, debtors, and currency holders. Several scenarios are possible. The first is a new Bretton Woods, a negotiated reconstruction of the international monetary system. This would require cooperation among major powers, agreement on rules and institutions, and political leadership capable of long-term thinking. Given the current state of international relations, this seems unlikely but not impossible. Crises have a way of concentrating minds. The second is fragmentation into currency blocks. The dollar zone, diminished but still substantial. A UN zone encompassing China's economic sphere. A eurozone, if it survives. Possibly regional currencies in other areas. This would be a return to the pre-1914 world of competing monetary systems. Less efficient than a unified order, but more resilient to single points of failure. The third is chaos. A prolonged period without stable monetary arrangements, characterized by competitive devaluations, capital controls, trade barriers, and economic nationalism. This was the 1930s model, and it did not end well. The fourth is something new. Perhaps digital currencies issued by central banks, perhaps private alternatives that gain traction as government currencies fail, perhaps a return to commodity backing in some form. The technology exists for monetary systems that were impossible a generation ago. Whether they would be better or worse than current arrangements is unknowable. What is knowable is that the transition will create winners and losers. Those who hold real assets, productive land, essential commodities, ownership stakes in businesses that provide genuine value, will fare better than those whose wealth exists only as financial claims. Those with skills that remain valuable regardless of monetary arrangements. The ability to grow food, to build things, to heal the sick, to solve practical problems, will find their services in demand. Those whose prosperity depends entirely on the continuation of current arrangements, on asset prices remaining elevated, on debts being serviced, on institutions functioning normally, will discover how fragile their position truly was. Nations that emerge from the crisis with productive capacity intact, social cohesion preserved, and political systems capable of adaptation will recover. Nations that enter the crisis divided, hollowed out, and led by institutions that have lost legitimacy will struggle for years or decades. The world after 2026 will not be the world before it. The only question is whether we will navigate the transition with wisdom and foresight, or stumble through it blind, learning the lessons only after paying the price. There is a moment in every disaster when escape is still possible. When the signs are visible, the path is clear, and the only obstacle is the willingness to see. The passengers of the Titanic had 2 hours and 40 minutes between the collision with the iceberg and the ship's final plunge. For most of that time, the band played on. Passengers strolled the decks, irritated at the interruption to their evening. The ship was unsinkable after all. Everyone knew that. The engineers had said so. The newspapers had confirmed it. The maiden voyage had been sold as a triumph of human mastery over nature. Below the waterline, the ocean was already pouring through 6 compartments. The mathematics were settled. The ship could float with 4 compartments breached, not 6. The architect who designed her understood within minutes of the collision that the Titanic was doomed. But the passengers? They had absolute faith in a narrative that had already been disproven by reality. This is where we stand today. The compartments are breached, the mathematics are settled, the collision has already occurred. What remains is only the time between impact and submersion, time that most will spend in denial, in distraction, in the serene confidence that the authorities have everything under control. History does not remember kindly those who could have seen and chose not to look. In the years before Rome's fall, there were those who understood what was coming. They watched the currency debase, the legions weaken, the borders become porous, the institutions lose their grip. Some withdrew to estates in the countryside, preserving what they could. Some fled to the Eastern Empire, where civilization would endure another 1,000 years. Some simply made peace with the ending of an age, but most Romans, even as the fabric unraveled around them, could not conceive that the eternal city might fall. Rome had stood for 1,000 years. It had survived invasions, plagues, civil wars, and mad emperors. Surely it would survive whatever challenges the current generation faced. The idea that they were living through the end was literally unthinkable. And so they thought nothing, until there was nothing left. The British Empire at its zenith ruled a quarter of the earth, its surface, and a quarter of its population. The pound sterling was the unquestioned reserve currency of the world. British financial institutions set the terms of global commerce. The City of London was the center of the economic universe. Within 2 generations, all of it was gone, not through conquest, not through revolution, through the slow accumulation of debts, the gradual erosion of productive capacity, the steady loss of competitive advantage, and 2 world wars that drained the treasury and shattered the illusion of invincibility. In 1945, Britain was victorious and bankrupt. The empire was dismantled not by enemies but by creditors. The torch passed to America, and the British learned to live in a diminished world, nostalgic for a greatness they could no longer afford. America in 2026 stands where Britain stood in 1945, where Rome stood in 400. Where every great power has stood at the moment when the bills come due and the accounts must be settled. The debt cannot be repaid. This is not pessimism. It is arithmetic. The bubbles cannot be sustained. This is not prediction, it is physics. The trust cannot be restored by the institutions that squandered it. This is not cynicism, it is observation. What comes next is not within our power to prevent. The forces have been set in motion over decades. The debts have been accumulated across generations. The imbalances have been building since before most of us were born. The collision with the iceberg has already occurred. What remains within our power is how we respond. There will be those who see clearly and act accordingly, who reduce their exposure to a financial system built on promises that cannot be kept, who build resilience into their lives and communities, who prepare for a world that operates on different rules than the one we have known. There will be those who profit from the chaos, who position themselves to acquire assets at distressed prices, who understand that the greatest wealth transfers in history occur not during booms, but during busts, who see crisis as opportunity. There will be those who suffer through no fault of their own, simply because they trusted institutions that did not deserve trust, because they believed narratives that were designed to deceive, because they were never told that the game was rigged against them from the start. And there will be those who find meaning beyond material wealth, who discover that the connections of family and community, the satisfaction of useful work, the resilience of simple living matter more than portfolio values that can vanish overnight. The crash of 2026 will not be the end of the world. It will be the end of a world, the world of infinite debt, of eternal growth, of something for nothing, of consequences indefinitely postponed. What rises from the ruins will depend on choices that have not yet been made by people who do not yet know they will be called upon to make them. History offers no guarantees. The aftermath of 1929 brought both the New Deal and the Nazi Party, both the greatest generation and the greatest war. The path from crisis to renewal is not automatic. It must be chosen and fought for and built with intention. The silence before the storm is ending. The question that remains is not whether the storm will come. It is whether you will be ready when it arrives, and whether, when future generations look back on this moment, they will say that we saw it coming and did nothing, or that we saw it coming and chose to act.